Kind of a flat open. Happy Monday, everybody. About even on the advanced decline line. 3 straight declines for the S&P 500. We'll see how that wraps up. Obviously, Turkey's an issue. Just look over Europe. Modest declines in Europe, but the bank's down a little bit more than normal, and that's typical. You would think they're lenders to Turkish corporations. So some of the banks, Intesa Sanpaolo, Banco Santander, all of them are on the weak side. So down about 1 to 2% here. Dollar's flattish today, but we had a big jump on Friday, so emerging markets are generally a little bit on the weak side. So South Africa, Brazil, Taiwan, India, all down about 1% on that dollar strength that we've seen. Here in the U.S., techs and materials leading, but very modestly. Healthcare up, banks are down. Second day in a row. As you can see, the financials are weak here. I keep emphasizing the main theme to bear in mind, which is the U.S. is the place to be. And I just want to show you the global markets, our outperformance. S&P 500's up about 6% year to date. The iShares all world, you can buy this CWI, the whole world, 50% is the United States, is only up 1%. But if you take out the United States from the global markets, the global markets are down almost 6%. So S&P up 6%, the rest of the world essentially weighted down 6%. That's what I'm talking about. The U.S. is the place to be, and earnings are the main reason. We keep pointing out U.S. second quarter numbers. Why do we keep talking about up 24%? Because look, compared to the rest of the world, Europe 9%, Japan 9%, and it's not just the tax cuts. If you take the tax cuts out, it's up about 15%. Even without the tax cuts, way outperforming the rest of the world. So again, U.S. the place to be, number one, because of the strong earnings narrative. Number two, we've got the GDP growth that we've been talking about. We're going to hit 4% here. So what's moving the markets here? That's it. And then we got the tidal wave of buybacks and dividends. We had a limited tariff impact. We've got the rotation we keep talking about. Occasionally value names come to the fore. That's the good news. Here's the bad news. Couple of things. The markets are very tightly wound. A lot of trades in one direction or another. We've got record highs in all the indices. We've got a lot of call buying out there. A lot of people betting volatility will remain low. Remember, we saw that earlier in the year. That blew up here. The dollar is very strong. We've got a lot of dollar bulls out there. That's a lopsided trade. We've got a lot of treasury shorts out there. That's a lopsided trade as well. And we saw what happened on Friday when you get all these dollar bulls out there and then you get a little problem overseas. A lot can happen very quickly in what looks like a small problem. So this gets to that debate. Is there too much complacency out there? My heavens, I got email after email saying, you got to be careful here. We've got slower growth. We've got higher trader rhetoric. We've got the Fed hiking rates, so we have higher deficits and higher debt. The decline in government revenues everybody keeps talking about. Corporate tax receipts are down 30%. Overall. None of this has translated into anything significant for the markets. Internally, advanced decline line remains near record highs. That's the most important thing to watch if you want to see signs of a slowing market. There's very good history that advanced decline line goes south 4, 5, 6 months before the market truly completely tops out. We're not seeing that at all. Advanced new high stocks, it's been fairly modest overall because we've had a few stocks pushing the markets up. But overall, no internal signs of deterioration. I still say the United States is the place to be right now. Flattish. Dow's up 27 points.